All right. Well, I am joined today by Kenny Gatliff. Kenny, it's been like a year since we've hit record on this to have a conversation. You and I see each other all the time in the office, but it's nice to be officially recording a conversation with you.
Yeah, good to be back. It's been a lot going on, so we certainly have no shortage of things to talk about depending on how long we want to go today.
No kidding. No kidding. Well, you're generous with your time. And when I reached out to you, I've just been getting a lot of client questions. And as I'm answering, I'm thinking it might be good to get a second perspective on this, especially with your background. So for those of you out there that are watching this, Kenny Gatliff is a investment manager, a CFA level investment manager. He and I have worked together for many years. And so I really rely on Kenny for a lot of just portfolio and investment insights. So that's what I'm hoping to tee you up with today, Kenny. My first question that again comes from with a lot of these clients that I'm working with is, we see these geopolitical events, these wars, these conflicts, invasions, and then we see the market react to that. I mean, and a lot of these conflicts are very, centrally located around the globe. But why does the entire global market seem to be impacted by invasions and conflict and tension?
Yeah, it's a good question. Obviously, it's been timely, certainly over the last several months, and I think it's important to kind of take a step back and look at what is the pricing mechanism of the stock market in the first place, and to put it in very basic terms, it's the current estimation of future profits for any one company, and then times all of the companies in the stock market. And so, one of the biggest factors when I'm looking at future profits, what do those future profits are going to be is going to be uncertainty in the market. If we feel really confident in the profits 1 year from now, 3 years from now, I can feel confident in what the price of that company is going to be, what I'm willing to pay for its stock price. On the flip side of that, if there is uncertainty introduced in the market, depending on how much this scales, what all of the different mechanisms of a geopolitical event, whether we've got supply chain issues with, we've got straits being closed, we've got, oil being restricted, and, that obviously impacts a lot. So all that to say is that introduces a lot of uncertainty to a lot of different companies. All of these different things are intertwined. And so when there's uncertainty about future profits, that's uncertainty about current stock prices. And so that does tend to drive stock prices down.
Got it. Yeah. No, good point. Current stock prices having everything to do with certainty, uncertainty, what people believe the future of the company is capable of, right? And so it kind of leads into my second question. So, Kenny, with as we're recording right now, we're still seeing a lot of the unresolved conflicts, specifically between the U.S. and Iran. A lot of back and forth. So a lot of unresolved tension and conflict, yet we're seeing the market recover. What's going on with that? Why do we typically see market recovery even before wars are completely bypassed and resolved?
Yeah, I would say it's the same idea. So when something, especially, there's a shock into the market, in this time, the invasion of Iran and all of the, surrounding issues with that was kind of a surprise. And so I think early on with any, market shock, there's just a lot of reactionary moves and prices can get dropped pretty precipitously and very quickly. And we've seen this. We saw this with COVID. We saw this with the tariffs last year. There's a lot of examples where you see pullbacks of 10, 20% in a very short time period because that uncertainty is introduced. And oftentimes, I don't want to say it's overblown, but the more unknown there is, the more people will affect their purchasing decisions, which affects the price of these stocks. And even without full resolution, just knowing that maybe this isn't a good thing, but maybe it's not worst case scenario, people just get a little bit more comfortable with, what is now status quo, a month in, 2 months in, 3 months in, we're saying, okay, we kind of know what we're dealing with here. And there's less expectation of there being, something more catastrophic. So that gives people a little bit more of the comfort level of, anticipating what impact this is going to have on those future prices and therefore what impact it's going to have on, current stock prices.
Yeah. All right. I get this question a lot, Kenny. Curious how you would answer it. if we know that the market has some short-term volatility tied to these conflicts, why do we as investment managers not just move, all investments to cash during a conflict, wait for the conflict to resolve, and then get back to the investments, get back to the portfolio as it stands? Why are we not doing that?
Yeah, I'll give you kind of a two-part answer. One is you answered it, earlier in your second question is that nothing has really changed. That there's still a lot of escalation of tension. That we're still having. The issue with Iran has not been resolved by any means. But as you said, depending on what part of the market you're looking at, a lot of it has fully recovered even without that resolution. And so, from that aspect, it's just not that simple to know when prices are going to move. But the second part of that answer is that when we are looking back at the pricing mechanism of the market, there's millions and millions of participants acting essentially instantaneously as news comes in. So, in order to make a decision to get out or get back in, depending on what that expectation of the market is, you would have to have some level of knowledge that the regular market participant wouldn't have. If you're the Secretary of War, we're about to invade Iran. Well, yeah, maybe you might be able to make a play in the market, but fortunately, that's generally illegal to do through insider trading. So, for most of us, we don't have that level of information, and because the market does price in this new information almost instantaneously, there is no real way of selling out right before it drops or getting back in right before it goes up, because everyone is seeing the exact same information that you and I are. And there's just so many different levers being pulled at the same time that there's really no way to, arbitrage that and gain any advantage.
Yeah, definitely. No, well put, Kenny. Yeah, I've heard it said before. I like thinking it in terms of there's no bell that's rung. There's no bell that's rung at the bottom signaling that the recovery is coming. There's no bell that's rung at the top saying, hey, we're at a high point. We're about to drop. Although the market's always growing and expanding, but we don't have these known markers of what the bottom of the trough is and what high points are. And so just staying invested through for the long run, tends to be the play. I would say this, and this is more particular for the clients that I'm working with. I don't work with a lot of day trading types of clients. It's investors for the long run that are preparing for or already in their retirement. It's just understanding what your plan needs. How much do you plan to consume out of your portfolio over the next year, 5 years, 10 years, maybe beyond, and building some safety around the assets that you may need to consume, regardless of what's going on in the world. It was about a year ago, Kenny, that we were talking about the tariffs. Now we're meeting about the recent market pullbacks from the conflict in Iran, and it's always something. I mean, it's always something new, but it's always something we see the markets go up and down, and that's just what they do. But no, Kenny, this is great. I really appreciate your insight. Any final, not to put you on the spot, but any final thoughts before we wrap up? We're close to our 10-minute mark, but I want to give you the last word.
Sure. Yeah. No, I really like what you said in that, we tend to get caught in the weeds of what's happening right now. And we want to overanalyze this conflict and, how markets are priced and what it's doing. But realistically, if it's not this thing, it's another. We brought up already, there's been 3 or 4 similar but very different, market impact events just in the last few years. But when you look at long-term returns, as long as you're investing properly, meaning your risky assets, you're giving them time to go through these ups and downs, and your less risky assets that you're using consumption aren't exposing yourself to these ups and downs. It really doesn't matter, whether this, I'm not saying, globally, it doesn't matter what this conflict does, but for your money, for your investments, it doesn't matter if the market pulls back 20% over a month and, comes right back, or whether it takes 6 months or a year to come back, because, we know long term, we have enough evidence to support that, if you're invested broadly in the stock market and give it enough time, it is going to eventually recover and go back up. And so as long as we're investing with that in mind, we need to, it's interesting to have these conversations of, how quickly things move and why. But realistically, it's not important for someone's plan to work if they are doing kind of all those things that you mentioned, investing wisely and prudently.
Awesome. That's beautiful. Let's end with that. Kenny, thanks so much. And hopefully we'll talk soon. Hopefully it doesn't take another year before we record again.
All right. Sounds good. Thanks, Dan.
All right. Thanks. Bye.